Hello and welcome. My name is Kathleen Lobito, and I will be your host for today's webinar on managing your money after the military. Our presenter today is Josh Schnelle, Relationship Manager with AAFMAA Wealth Management and Trust. Before we begin, here's a quick background on the association. This webinar series is brought to you by AAFMAA Wealth Management and Trust. Our mission is to be the premier provider of financial planning, investment management, and trust services to the American Armed Forces community. AAFMAA Wealth Management and Trust is a fully owned subsidiary of AAFMAA. AAFMAA has proudly served America's armed forces since 1879. AAFMAA is a nonprofit, tax-exempt 501c23 member-owned mutual aid association offering life insurance to all branches of the U.S. Armed Forces and their families. And just a few disclaimers before we begin. This presentation is educational. It's for general information only and is not specific investment, legal, or tax advice for any individual. Do not rely on this presentation alone to guide your investment management decisions. Since each situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members to help them better understand the resources available to them. We have highlighted here two distinct characteristics that separate AAFMAA Wealth Management and Trust from other service providers. One, our fiduciary standard, which requires us to always act in our clients' best interests. And two, we exclusively serve the U.S. Armed Forces community. Now, without further ado, I'll go ahead and turn it over to Josh to begin the presentation.
Thank you so much for that introduction, Kathleen. It's really a pleasure to be here to talk about such an important topic, which is managing your money after the military. And as a military veteran, I know that transitioning to civilian life involves many different decisions and it creates a lot of different emotions as well, ranging from excitement to stress. And really just fortunately for you, many people have gone through this before and we can learn a lot from their experience. And we want to share our knowledge as well to help you make a plan for managing your finances throughout your transition. Now, today I will address several personal finance topics and make recommendations on specific action items to prioritize. Because you have a lot on your plate as you transition, we wanted to provide something that can be helpful to help relieve some of that stress. So this webinar should provide you with a process for addressing your financial future and offer you some practical tips to help you address these important topics. According to Einstein, the only source of knowledge is experience. So today, I want to share knowledge gained through others' experience so you can learn best practices. According to research, 48% of veterans said their transition was more difficult than they expected, while 76% agreed that their transition was stressful. Again, you have a lot going on as you transition. I know I did when I made that shift from active duty to civilian, and it's very likely that your transition will be harder than you expected. So at some point, you are going to put something on the back burner. Do not let it be managing and planning your personal finances. It bleeds into so many other areas of your life, and it really needs to remain a priority. Surveys have indicated that 73% of Americans rank finances as the #1 stress in their lives. And transition is already a stressful period for you and your family. So having a great handle on your personal finances can help alleviate some of that stress and hopefully make your transition a much more enjoyable process. Now, before we get into specific financial areas to address, I'd like to offer two broad suggestions. First, envision your future. Then second, we can create a plan to get there. Before we can really understand what plans need to be put in place, you need to take the time to really think about what you want your future to look like. If you're planning on a second career after the military, what type of work will you pursue? And will that require additional education? And how long do you plan to work in this second career? And then maybe after you finish that second career, what does that look like? Will you continue to volunteer in some capacity? Maybe you'll continue to work full time for some company that you just have a passion for, or part time. A lot of times after someone is fully retired, they have what's called an encore career because they just found something they're really passionate about and love doing. Maybe that's something that you would like to do. Where do you want to live? Right now, it's kind of been easy probably because the military's just been sending you around the world. But now you have to make the decision, where do you actually want to plant roots and live? And is that cost of living going to be comparable to what you're used to? What are some of the specific things that you want to do, either in the second career after the military or after you fully retire? Do you want to be able to fish often, or do you want to be able to golf a few times a week, or possibly travel the world or travel the US? Maybe even you want to build some remote cabin in the mountains. These are the things you need to be thinking through in that first step to help envision the future. And envisioning your future is such an important step because you cannot accurately plan for your future without a picture of where you're trying to go. Your specific goals and circumstances will affect how you tackle that next step, which is to plan. So you may be surprised to hear that many Americans do not spend much time on retirement planning. In fact, on average, only 11% of Americans spend as much time on retirement planning as they do vacation planning. And a vacation may last a week or possibly longer if you're lucky, while retirement will probably last 20 years or more. So which one do you think you should devote more time to planning for? And in addition to retirement, there are many more financial areas that you need to be planning for, which also have a significant impact on your life. In fact, there are actually a few areas that we're going to cover first today that are more important to take care of before you ever start planning for retirement. And you probably already know this, but diligent planning takes time and effort. But believe me, it is a worthwhile effort because the hour or two that you put into planning each month can make an enormous impact on not only your future, but your family's future as well. Long-term success in almost every endeavor can be linked back to planning, and that's especially true when it comes to financial planning and in your financial life. Today, we will discuss a few key areas to plan in order to set yourself up for success. So as we dive into planning for that future that you have envisioned after the military, we're going to look at ways to plan for protecting your near-term future, and then talk about ways to plan for your long-term future. And both are areas you need to be especially focused on during your transition, as some of these choices cannot be undone. So let's start with addressing the foundation, protecting today. When I was in the Army, I served as an air defender. And if you happen to be an air defender, you are sure to remember our motto, first to fire. As a strategic defense around the globe, one of our objectives was to protect the US and our allies' interests against a first attack so that our follow-on forces could come in and subsequently win the fight. And we were there to protect today so that other military assets could win tomorrow and the subsequent long-term future. Well, how does that translate to personal finance? Well, what good does it do your family if you have a 30-year savings plan that you're executing, but then you have an unexpected death 2 months into your plan without any life insurance? How long would your family be financially okay without you? Would they be able to stay on track for the long term? This is only one example of the need to protect your present. I know that a lot of the time we focus on setting big goals for our future, which is great. I'm a huge believer in setting big long-term goals, which is part of that Envision step we've already discussed. However, too often we forget to prepare for the near-term events that could derail the long-term plans by first planning for what-if scenarios. And one of my favorite quotes by Eleanor Roosevelt is, "Yesterday is history, tomorrow is a mystery, and today is a gift. That is why it is called the present." So let's review a few key steps to properly protect you and your family as you step away from some of those military benefits that you may currently have in place. an emergency fund. Having an emergency fund is a foundational step in personal finance. It keeps you from needing to use high interest debt, which leads to longer term financial struggles. If you have a transmission go out, or your kid has a trip to the ER, or you get laid off, or you have something unexpected happen, do you have an emergency fund to prevent you from using debt? According to a 2018 report on the economic well-being of US households, about 39% of Americans could not cover a $400 unexpected expense without going into debt. And it's because of this that it's typically recommended to maintain 3 to 6 months worth of non-discretionary expenses. If your household has 2 or more sources of income, then 3 months is generally sufficient. But if your household has only one source of income, then 6 months worth of expenses is suggested. And remember, non-discretionary expenses are those expenses that do not go away if you lose your job. You have to continue paying the debt that you owe or the bills that you owe. Those are non-discretionary expenses. Now, however, if you're transitioning right now to the civilian world from military service, you have more uncertainty than most any other time that you're going to have in your life. And many veterans actually experience some employment gaps of more than 3 months after transition. And many of the benefits that you may be expecting, whether that's VA disability or a military pension, those actually can take much longer than expected to actually make it to your pocket. Due to this uncertainty, I recommend 9 to 12 months of non-discretionary expenses set aside. And then once you settle into your new life after the military, that amount can be reduced back to that 3 to 6 month range. Also, having a defined budget really helps you know how much your non-discretionary expenses are. So this is something I recommend doing now. There are some really great tools out there to help you with budgeting and tracking, and I'm going to cover those a little bit later today. But if you do not have an emergency fund right now, you need to immediately start building one. Even if you can only save $50 a month, you need to start there and then try to add more when you have excess income until you reach that emergency fund goal. This takes discipline, and it may mean that you have to cut something from your monthly expenses that you really don't want to cut until you get to this foundational goal. But it's really important to get this set up first to help prevent you from falling into any debt traps in the future. Another foundational topic is your insurance coverage. And I know that insurance is not a fun thing to talk about, but it is critical to protect you and your loved ones. And I know a lot of people have had a negative experience with an insurance salesman. I think we all have. But that's why it's very important to get an insurance analysis from someone who is objective and is a fiduciary. So a reminder, a fiduciary is someone who is legally bound to provide you with recommendations that are in your best interest. So anytime you're seeking financial advice, ask if the financial professional is a fiduciary. Here at AAFMAA Wealth Management and Trust, we do an insurance analysis as part of your financial plan. We evaluate your overall situation and goals, and then we can recommend a specific amount of insurance coverage to meet those goals. And then after that, we recommend you go seek quotes for that coverage from 3 different companies. We are not compensated for any of the insurance that you may end up purchasing, which helps you know that we are only recommending what we think is best for you. And that's really important when you're trying to decide what the right coverage is for you. So let's talk about a few things that you should know about life insurance. When you separate from the military, it's very critical to review your life insurance options right then, because some options are limited to a certain period after your service. For example, you're eligible to convert your SGLI to VGLI without a medical screening as long as you make that change within 240 days of separation. Many times you can actually go and find a better rate with a different life insurance provider if you're in good health. So it's recommended to go ahead and apply for those coverages before your 240 days are up. And if your health screening comes back with good results, then you can most likely opt for something other than VGLI and save some money. However, if you do apply in that window and then your health screening has a negative impact on your insurance cost, you can opt for the VGLI without going through a medical exam. Another decision to make is whether you think you need term or permanent life insurance. And the most basic explanation here is that term insurance will expire at a set date, usually 10, 20, or 30 years later, and is therefore much cheaper than permanent life insurance, which will actually never expire as long as you pay the premiums, and in some cases can grow a cash value benefit. Your specific circumstances will help you determine how much protection to get and which option is best for you, whether term or permanent. However, a rule of thumb that we use out there in the industry is having life insurance coverage that has a death benefit of 10 to 16 times your annual gross pay. Your spouse should also have enough life insurance on themselves to cover the loss of their contributions to your family's income and responsibilities, regardless of their employment status. So even if they're currently not working, you have to consider what value are they bringing economically to your family, because if they're currently watching the kids and then something happened to them, that's a cost that you would now need to start paying for some childcare, which, as all of us with kids know, can be pretty expensive. Now, lastly, I do want to remind you that life insurance really isn't for you. Oftentimes we think of it as just an expense that we don't want to have to pay, but it's for your family. You know, an insurance analysis can help you understand the specific amount that you would need to help cover your debt or living expenses for a certain period of time so that your family is taken care of if something happens to you unexpectedly. This is another area that needs attention immediately because the impact of not having adequate life insurance can be catastrophic. Now, as life insurance is there to protect your family if you have a premature death, disability insurance is here to protect you and your family if an accident or illness prevents you from being able to work and earn an income. Unlike life insurance lump sum payment, disability insurance will actually replace a portion of your income each month if you meet the disability qualifications. And most of us think this just won't happen to us, but the truth is that 1 in 4 20-year-olds become disabled before retirement. So I want to say that again. 1 in 4 20-year-olds become disabled before retirement. There are 2 main types of private disability insurance, short-term and long-term. And the main difference here, but you can tell by the title, is their benefit period. So short-term coverage typically gives you a benefit of somewhere in 3 to 6 months, while long-term insurance, those benefits can range from 2 years all the way until retirement age. And on top of the time periods, there are many different options for the type of coverage you would like, such as having it replace 50% or 60% of your current income. And then you can also choose if it covers loss of income from only your current occupation or any occupation. And this can be a little bit confusing. So I want to give you an example here. If you had own occupation disability insurance and you are a medical doctor, then any disability that prevents you from performing your functions as a medical doctor would allow you to receive benefits. On the other hand, if your coverage was for any occupation, then the disability would have to prevent you from receiving compensation from any occupation that you were qualified for. And that's based on your education, experience, and age. And then if you were prevented from working based on that criteria, then you would qualify for benefits. Now, sometimes the coverage will allow you to have benefits to fill the gap between where you were working before, so what you were earning before the disability, and what you are currently earning now that you are able to work in some new capacity. The cost obviously is something we're all interested in, and the cost will vary based on your type of occupation you have coverage for, the length of coverage, the percentage of income replacement you select, as well as a few other factors. So as you can see, a lot goes into this decision, and seeking advice from a trusted professional can add a lot of value here. Ideally, that trusted professional is helping you evaluate your options as a part of your complete financial plan so that you can see what is most appropriate for your overall needs, goals, and of course, your budget as well. You know, additionally, With disability insurance, there is a benefit available from the government for long-term disability. However, in 2019, the average disability payment was just over $1,200 a month, which would barely be over the poverty level. And to receive benefits from the Social Security Administration, a person must meet the definition of disability under the Social Security Act. And a person is disabled under the Act if they can't work due to a severe medical condition that has lasted or is expected to last at least 1 year or result in death. And the person's medical condition or conditions must prevent them from doing work that they did in the past, and it must prevent them from adjusting to other work. So what that tells us is it's a lot more stringent and strict process to become eligible for these benefits compared to becoming eligible for private disability insurance benefits. Long-term care insurance. In my opinion, long-term care insurance is probably the most underrated insurance coverage that exists. Most people just cannot visualize a day when they're going to need this coverage. And when they finally reach that age where they start to see that, oh, long-term care may actually be needed in my future, well, the coverage is often no longer available or just no longer affordable. And most people who I find that do end up seeking long-term care coverage early in life have experienced taking care of a loved one who needed long-term care. And they were able to see that and understand how impactful coverage can be. And we learned back in February from the AAFMAA Wealth Management and Trust long-term care webinar that 70% of people will need long-term care in their lifetime. And on that note, if you would like to go check out the long-term care webinar or any of the other webinars we've done in the past, you can go to AAFMAA.com, click on resources, then webinars. There's a lot of great information there. So back to long-term care insurance. If 70% of people will need long-term care in their lifetime, then it really is more of a question of when, not if. And it's important to know that having a disability or a VA disability rating does not automatically disqualify you from long-term care coverage, but it really depends on your specific health situation. However, if you do not qualify, you apply and you don't qualify for traditional long-term care insurance, there are some alternatives that may work for you. Sometimes, for example, permanent life insurance has a benefit that allows you to take some of your death benefit each year if you encounter a long-term care event. And this is just another reason to be looking at your plan as a whole so you can see where some areas of coverage may overlap. Health coverage. There are so many options out there for medical coverage that we could spend hours on this subject. But what's really important to recognize during your transition is that many of these health benefits were free while you were serving in the military. So you need to plan ahead on where you will seek your health coverage and include those new costs in your new budget. If your new employer offers coverage in these areas, spend time evaluating your options, as the decisions you end up making there can have a significant impact on your finances. And don't be afraid to ask questions when you're onboarding. I'm sure there's a benefit coordinator or someone that you can call and talk to try and get an understanding of all your options. Or you can also reach out to an outside professional financial planner if you need help, especially one who understands military income and lifestyle that can really provide a great value and great benefit to you to get that outside perspective. Now, for this health insurance coverage, I really want to focus on what a health savings account or a flexible spending account are, because these are both ways to save for medical expenses before your income is taxed. Now, the HSA is what we're going to cover first. And to be eligible for an HSA, your health coverage has to be considered a high deductible health plan. Now, you can then contribute pre-tax dollars into your HSA. And sometimes employers will have a match on your contributions to your HSA, making it even more appealing to do so. But you put that money in before it's taxed. So it's coming out of your payroll directly to your HSA. Then in the future, if you need to spend money for qualified medical expenses, you can take them out from your HSA and pay for the qualified medical expenses and have never paid taxes on it. They remain tax-free. And those funds can actually roll over each year. And after a certain dollar amount saved, they can start to be invested for long-term growth. And then the growth is actually tax-free as well. So this allows for triple tax savings. Your money goes into the HSA tax-free, it can grow tax-free, and then it comes out tax-free if it's used for medical expenses. And it doesn't really get much better than that when you're looking for some tax savings. Also, an HSA can also act as a tax-deferred retirement savings vehicle. So once you turn 65, you can use your HSA to pay for other things other than medical expenses. You will just be required to pay income tax on your withdrawal in the same way you would an IRA if those funds aren't used for medical expenses. If they are used for medical expenses, which I think we all know at age 65, we're going to continue needing medical expenses, then they continue to be tax-free when you make those withdrawals. Now, the flexible spending account, the main difference here with the FSA and HSA is that the flexible spending account is a use it or lose it benefit each year. So there's really no long-term growth potential here with an FSA, but it still may be a great tax saving strategy if an HSA is not available to you. So you can put that money away pre-tax and then use it the same year to cover medical expenses. You just have to be a little more careful and precise in your planning to make sure you don't set it aside more than you're going to use that year, because you can't get it back the next year. All of the areas that we have talked about for protecting the near term should be evaluated to see how it will affect your overall plan for meeting your goals. If you are seeking professional help with developing a financial plan to address all of these topics, make sure that they're able to stress test your current situation for these different events. These stress tests will be able to give you that clear picture of how different events could impact your goals, and then give you an objective view at the areas that you can improve upon. Now that leads me right into the next stage of planning. After you've addressed ways to be prepared in the short term, it's time to address the ways to plan for your near, mid, and long-term goals. Now, as mentioned earlier, envisioning and discussing those long-term goals is really key in helping you determine how much you need to save and how to save it. However, if you don't have a specific goal in mind, you can still work on saving right now, because I guarantee you that at some point in the future, you will have goals that require funding. So even if there's not something that you can point at and say, this is a specific goal, you should go ahead and start saving. All right, as a part of your near-term plan, you should have already gone through a cash flow analysis and have a cash flow analysis in place. It's also known as a budget, but we've found that budget is just one of those terms that people tune out. They don't want to hear you tell them to have a budget, but we're going to call that a cash flow analysis. So as you shift your focus into long-term planning, it's important to continue tracking your inflows and outflows through a cash flow analysis. There are some fantastic tools out there that you can securely link your accounts to and then allow their software to track your expenses. I personally have used mint.com for many years, and I really love that because you can go in there and create a budget within the app or cash flow analysis and set alerts for when you've gone over in a certain area, and it'll help you stay on track and monitor your spending. Some other popular cash flow analysis tools and tracking apps that do similar things are You Need a Budget, or YNAB. There's Personal Capital, as well as a few others that are offered out there that you can look up. We also have our own budgeting and tracking portal here that you can use through our financial dashboard. You just need to reach out and ask for access to that, and we can provide you that access. And if you don't currently have a cash flow analysis or a budget in place, well, it can be hard to get yourself to start. So your mindset is really key to this. And one thing that I found is that many people think of a budget as restricting them, and so they just avoid it altogether. However, you can work on shifting that mindset and think of a budget more as giving you permission to spend money on things that you like and want without having to feel guilty or anxious about doing that. So if you already know that your budget is covering your essentials and your budget allocates $100 for shopping, then you've just given yourself permission to go spend that money. And it is important to remember, though, that your budget should include your planned savings and investments as essential expenses. Those should not just be left to whatever's remaining at the end of the month. Setting up automatic savings is one of the best ways to accomplish that goal, because as humans, we're naturally inclined to take the path of least resistance. That's why we end up signing up for several subscriptions and then forgetting about them, and they're just on autopilot and we keep paying for them. So let's turn that into a positive thing by putting your savings on autopilot. Sign up for an automated system for saving. That can apply to all the different areas that you're trying to save to reach your goals in. All right, investing or investments. This is the section that most of you were probably waiting for, how to make money. It's the topic that most people, when I talk with them, that's what they want to focus on when it comes to financial planning. And I want you to do well. This is definitely one of our goals, to help you do really well with your investments. But just remember, it's only one piece of the puzzle when it comes to having that well thought out financial plan. So as you transition, there are several topics that you should address first before coming to this topic, but we've already addressed those today. So now let's talk about a winning investment strategy. A winning investment strategy is not going to be some flashy, exciting, get rich quick strategy. It's quite the opposite, really. A sound long-term investment strategy needs to be a methodical, consistent, boring strategy where you consistently invest every month into a diversified portfolio based on fundamental investment analysis. It should not be based on the hype that is currently on Reddit or Discord, or from your high school buddy who knows you should just invest everything into this one new amazing company they just read about. No, it should be based on fundamental investment analysis. Remember, your investments are set up to help you get to your midterm and long-term goals. So no matter what the goal is, you want to have time on your side to start saving as soon as you can, because compound interest is potentially one of the most powerful tools in growing your investments. One common goal out there today that I hear often is not outliving your money in retirement. And that seems like a pretty common sense objective. However, many people are really surprised when they find out how much they actually need to have saved to fully fund their retirement. And no matter where you're saving for your retirement, we see the best approach is consistent long-term investing. And again, I'll say this again, one of the best ways to do this is through automatic investments. If your employer offers a retirement plan, you can elect to contribute a portion of your paycheck before it ever reaches your bank account and then tempts you to spend it somewhere. Another question I get asked a lot is, how much should you be saving for retirement? Well, an exact answer is dependent on your specific goals and how much you have already saved, but there are a few rules of thumb that I want to cover. So a benchmark savings ratio target is 10 to 12% of your annual gross income if you begin saving before age 32. Now, if you wait until after age 32, the amount moves up to 12 to 15%. And if you wait until age 45 or 50, the rate increases to 15 to 20% of your annual gross income. And to calculate that annual savings ratio, add your employee and employer contributions, including any profit sharing you may have access to, and divide that total by your annual gross income. If your employer does not offer a retirement plan, there are still some other ways to achieve tax-advantaged retirement savings, such as in an IRA or a Roth IRA, and you can also set up automatic contributions to those as well. So what's the overall theme here? It's invest consistently and early to take advantage of your most powerful tool, compound interest. So I want to take a quick look at some practical examples of that approach. As you see here, from left to right, these are three different individuals, and they start saving for their retirement at three different time periods. One starts at 25, the second starts at 35, and the last one starts at age 45, and they're each going to save until age 65. The first one on the far left, they start at 25 and they save $3,000 a year for 40 years. So it's not a significant portion of their income. And each of these individuals have an 8% annual rate of return. So after 40 years, that individual that started at 25 has now amassed about $842,000 in their retirement fund. The second individual starts 10 years later, so they increase how much they're going to save per month or per year to $4,500 a year instead of $3,000 a year, but they only have 30 years to do it. And so they end up ending up with $555,000 saved. And then the last individual, they decide they need to increase their savings even more. So they save $9,000 a year, but they only have 20 years to do that and let time compound and grow their savings. So they end up with the least amount, $453,000. And I think most of us have seen examples like this in the past, but it's just important to remember we want to try and get our money working for us as early as we can. And I don't show you this to be a discouragement if you didn't start at 25. The main thing here is to remember, don't wait another 10 years before you start saving for the long-term goals you have. And it's to start now and remember, slow and steady, just consistently invest for the long term. Although there is an order of priority when planning, when possible, creating that comprehensive plan is most prudent because it allows you to look at all those different pieces we've talked about today in your financial life, and then helps you create that roadmap to reach your goals. And once that plan you've created is in place, you should review it every 1 to 2 years so that you can update any changes you have and then make sure that you're staying on track. We've discussed a lot of information today, and the goal is to help you be better prepared for managing your money after your military transition. And the key is to identify your priorities and then take care of each one step at a time. And remember, don't be afraid to ask for help. This is a really important topic that can have a significant impact on you and your family. So reach out to people at your new employer or outside help, one of us here at AAFMAA Wealth Management and Trust, and get that expert advice that you need. Thank you guys so much for tuning in to learn more about how to manage your money after the military. If you missed something during the webinar today, or if you just like some additional clarification, please reach out to me. My email is listed here. It's jschnelle@afma.com, or reach out to any of our relationship managers who are here to help make sure that you have all the information that you need during this vital time. We were really happy to answer any of your questions and discuss your specific situation with you in greater detail. So please reach out. Thanks again for tuning in, and have a great rest of your day.